Some of you might have some questions during this session. Kindly add them to the chat box and we shall discuss them in the Q&A session. Now that I have everyone's attention, we shall begin. I will start by giving a brief introduction of our firm, Nadeem and Umendra Chartered Accountants, which has been in business for the last 16 years. Our name appears in the list of approved auditors in all the free zones in UAE, all the local banks and real estate regulatory authority, which is RERA, and various small authorities. We have 4 offices in the Emirates of the UAE. Our services include assurance services, taxation and compliance, business setup and liquidation, accounting and bookkeeping, business and financial advisory. Today's webinar is based on the UAE corporate tax. The Ministry of Finance of the United Arab Emirates on 31st January 2022 announced the introduction of federal corporate tax on business profits. On 9 December 2022, the Federal Decree Law of 47 of 2022 on the taxation of corporations and businesses was issued effective from October 23, 2022. The law is effective for the period starting from 1st June 2023. To be prepared for the corporate tax, the organizations have to evaluate the impact of corporate tax on their respective businesses. We had organized a few webinars for corporate tax earlier as well. The links to the same would be shared post-webinar via email. Moving ahead, in today's webinar, I would like to introduce the speaker, Mr. Sameer Popat. Mr. Sameer is the Director of Taxation at Nadeem and Umendra Chartered Accountants, DMCC branch. He is a qualified chartered accountant and a member of ICAI Dubai chapter. He has more than 15 years of experience working with various MNCs like Al Shirawi Group, ARJ Group, etc. He has in-depth knowledge of GCC, taxation, and compliance matters. He has conducted numerous seminars and webinars in the last few years. In this webinar, Mr. Sameer is going to analyze the corporate tax law, explain how to calculate the taxable income, discuss the anti-abuse provisions, and will throw some light on corporate tax registration as well. He will also explain the steps that businesses need to take in order to be prepared and get compliant with the law. And finally, we will have the Q&A session at the last. I will be requesting Mr. Sameer Popat to please start with this session.
Hello, everyone, and most welcome to all of you. Thank you for joining with us today. Basically, this particular webinar, what we are starting now is for a very particularly small size of clients that we are targeting, our clients and potential clients, which we want to focus on. So thank you for all of your and I'm sure that we'll add value to your knowledge or relating to the corporate tax. So without further delay, let us start. Already Ms. Khushbu has shared the agenda. I'll be throwing some light on the important provisions of the corporate tax law, which we feel that normal business owners and the accountants should be aware of. We'll see how the corporate tax will be calculated on the taxable income, and also we'll be discussing on the latest update that FTA has introduced about they have started registering the corporate tax, and we are going to speak on that as well. So what is corporate tax? It's a type of direct tax. It's different from VAT. It's not going to be replaced with VAT is not going to be replaced with corporate tax. It's an additional tax, but it's type of a direct tax. VAT, when we did a lot of seminars and when the VAT was implemented in UAE, we always used to say that VAT is not going to be a cost of doing business for the companies. But we cannot say that anymore because corporate tax for sure is going to take the tax will be charged from the profits of the company. So there will be a hole in the profits of the company. So that is why it is called a direct tax, wherein the tax is charged directly from the profits of the company. What UAE has done, UAE has introduced the corporate tax at the rate of 9% on the profits above 375,000 dirhams. Now, the figure of 375,000 dirhams is not yet finalized by the ministry. It will be finalized, and most probably it is going to be 375,000 dirhams, but it will be finalized after the cabinet decision. So until now, it was declared in the FAQs of the FTA and on the Ministry of Finance website, and also on the public consultation document. When it will be effective for the financial year starting from 1st June 2023. This is very important. We have lot of queries and lot of questions on this from our clients, that what if my financial year is from January to December? Do I pay on the proportionate amount of profits from June 2023 until 31st December 2023? No. When your financial year starts after 1st June 2023, corporate tax will be applicable on that particular financial year only. We'll see also, we have a slide prepared specifically on it, which will illustrate how for each company following different financial years, how it is going to be implemented. Corporate tax rate, once again reiterating, it has been declared in the corporate tax law, as Khushbu also highlighted that UAE has declared the UAE corporate tax law in December 2022, which specifies the corporate tax rate of 9% on profits above 375. Again, I would repeat that 375,000 dirhams is not yet fixed, but most probably it's going to be there. So any profits, any company generating profits up to the AED 375,000 dirhams, still they don't pay any tax. Any profits more than 375,000 dirhams, corporate tax rate of 9% will be applicable. Now, this almost everyone knows that yes, it is coming at 9%. And I wanted to cover this specific slide because in the public consultation draft, they had declared that free zone companies will be exempted, not exempted, free zone companies will be given the benefit of 0% corporate tax, because whenever you register a company with free zone, they promise you that 50 years there will be no corporate tax. And to honor that commitment from different free zones, the Ministry of Finance and FTA has taken the decision of not to charge corporate tax to the free zone companies. However, in the public consultation draft, which was issued, it was mentioned that if a free zone company deals with a mainland company, then their complete business income will come under the purview of corporate tax, and they will pay 9% on the total profits of their company for that year at rate of 9%. But there was an interesting change when they issued the UAE corporate tax law, wherein they have defined for free zone person qualifying income and non-qualifying income. Now, now they are stating that for free zone companies, if they earn a qualifying income, then that qualifying income will be taxed at 0%. But if a free zone person earns non-qualifying income, then it will be directly taxed at 9%. And also one minute point to be noted here, that on non-qualifying income, tax will be directly charged at 9%. I don't see a provision of, exemption of 375,000 dirhams zero rate. No, any income, any non-qualifying income generated by a free zone person, it will be directly taxed at 9%. So there is no relief of 375 dirhams in that. Applicability, the UAE corporate tax is applicable to all the businesses in UAE. There is a condition-based applicability to individuals and foreign entities. We'll cover that in coming slides. So if you have questions that whether it is applicable to free zones, yes. Whether it is applicable to offshore companies, yes, it is applicable. Whether it is applicable to sole establishments, again, yes, it is applicable. So any confusion you had in mind that no, it will not be applicable to certain categories or will not be applicable to DIFC free zones, financial free zones, no, it is applicable to each and every company registered in UAE, whether it is in mainland or free zone. And all of these companies will have to register for corporate tax, and they will have to file annual returns of corporate tax. So it's very important to keep that in mind that now or later everyone has to register with the FTA for the corporate tax, and they will have to file the returns. There are certain exempt persons which are exempted from corporate tax, and those are listed first being obviously the government entities and government controlled entities, and they are not directly in competition competing business with the private sector. Also the companies that are into extraction of natural resources, those companies are exempt from UAE corporate tax because these companies are already paying tax at emiratization level. Also the companies that are helping these extraction of natural resources company in their business of extraction, but they are activities not of extracting, but it's supporting such companies which are dealing in natural resources that are of UAE specifically. Even those are exempt. Then approved charities and public benefit organizations are also exempt from UAE corporate tax, but these charities and public benefit organizations will have to be registered with corporate tax. Also, the regulated private social security pension funds and investment funds are exempted from the corporate tax, but these certain categories of businesses will have to apply for the exemption to the FTA for them to become exempt from the UAE corporate tax. So, very important clause is who is a taxable person. It can be categorized into a resident person and non-resident person. So, resident person is simple as to any company that is registered or incorporated in UAE automatically becomes a resident person in UAE, and it will be considered as a taxable person. But there are companies which are incorporated outside UAE, but it's effectively controlled and managed from UAE. I can give you an example. Let's say there is a company registered in India, but the owner of the company, the complete management of the company is resident in UAE, and they are taking day in, day out business decisions relating to their company in India sitting here in Dubai. That means that particular company which is registered in India and functioning in India, but it's effectively being managed and controlled from Dubai, then the income of such company which is registered in India, their taxable, their net profits will be taxed in UAE and not in India. So that will be an interesting concept. This concept is very common among the countries that have already implemented and practicing the corporate tax or income tax on the businesses. So that same concept will be introduced here as well. Also, one more interesting point to be added here is any natural person conducting a business activity in UAE and earning income out of it on a regular basis, then that particular natural person will also be liable to pay corporate tax on its business income. There are certain exemptions given to natural persons, and again that is awaited by a cabinet decision, because they are going to specify that in which criterias or in which situations a natural person earning an income out of, let's say, tangible assets, which is property, sorry, whether it will be termed as taxable or not. So I would request all the participants to please keep.
जो मेरा जानने वाला है वो गया ओमान, वो होता तो कोई झंझट ही नहीं। तो उसको करो, कोई रेफरेंस दे दे। मैंने बोला उसको, मैंने बोला कि बात की कभी ड्यूटी चल रही है, मैं 15-20 दिन से बाहर। मैंने नौकरी छोड़ दी तो हमें क्या मनी होगा?
खुशबू,
यहाँ का मैडम में रहता था, मैडम या मैडम कोई स्थिति है
please be all the participants.
वहाँ रहता है।
Thank you so much. Guys, I would request please keep yourself on mute so that the flow of the webinar doesn't go away. So second is the non-resident person. So a non-resident person will become a taxable person in UAE if they have a permanent establishment in UAE, if they have a place of business from where they are conducting their business, even though they don't have a license registered in UAE, but they have a permanent establishment from where they are functioning, and that sorry, permanent establishment is in UAE, then it will their income will be taxable in UAE. Or if any non-resident person derives income from UAE, then such income will be taxable in UAE. And if any non-resident person or a company registered outside UAE has a connection, business connection in UAE and generates income out of it, sorry, then that also will be taxable in UAE. A branch of a resident person is not different and it will be considered as a part of the main registered entity and accordingly will be taxable. So in this, we need to understand how a business will have a permanent establishment. Sorry for my bad throat. So the criteria for permanent establishment of a foreign company or a free zone entity will be that if any company has a fixed place of business and that such place of business should be functional for more than at least 6 months or more than 6 months, or they have a dependent agent in UAE through which they take all the decisions, and that particular dependent agent is working specifically for that foreign company. In such cases, it will be considered that such foreign company has a permanent establishment inside UAE, and accordingly, their profits will be taxed under the UAE corporate tax. Another important concept comes is the qualifying free zone person. I have already discussed a bit before, and now we'll be going in more detail. So the UAE corporate tax law defines the qualifying free zone person as it will be considered as a free zone person only if it maintains adequate substance in UAE. It derives qualified income as specified in the cabinet decision, which is yet to be declared, and it has not elected themselves to be subject to corporate tax, because there is an option if a free zone person which is enjoying the tax benefit of 0%, if they want to voluntarily pay the tax at a rate of 9% on their profits, then they can voluntarily do so. And in order to qualify as a free zone person, they should not select such an option. And it complies with the arm's length principle and transfer pricing documentation of the law. So earlier, as I said, UAE had declared a public consultation draft wherein they had mentioned different scenarios wherein different types of transactions carried on by the free zone persons or free zone registered companies that will be taxable or not taxable. So first such transaction being which is simple transactions outside UAE. So if a free zone company does any business or generates any income by providing services or transferring goods to a company outside UAE, then based on the public consultation draft and reading with the UAE corporate tax law, which is declared, this type of transactions will be qualified as can be considered as a qualified income. Similarly, any free zone company doing transaction with other free zone companies, again, it can be considered as qualified income. A free zone entity having branch in mainland UAE, then as per the public consultation draft, that mentioned the branch will be separately registered in the corporate tax, and only the branch which is functioning in mainland UAE, only their profits will be taxed at 9%. Free zone person will continue to take the advantage of the main head office will continue to take the advantage of 0% taxation. Transactions between free zone companies and their group companies in mainland, in there, as per the public consultation draft, there was an interesting theory that okay, if a free zone company is selling goods to their group mainland companies, then for such transaction, the mainland company, which is in the group mainland company, cannot claim such an expense as a deductible expense. So it's like indirect way of taxing the transaction of a free zone company which is selling to the mainland company. One more debatable point was of sale of goods to UAE mainland company from the designated zone companies. Now we all know, we have been looking at the or practicing the VAT from so many past 5 years, that if a designated zone company sells goods to a mainland company, then mainland company becomes the importer to the mainland, and a reverse charge mechanism is applied, and the designated zone company does not charge VAT on such transaction, and the mainland company accounts for the tax liability on the import. It will be considered as if the mainland company has imported the goods. So even in public consultation draft, they had mentioned that such transactions, if a designated zone company does, then they will continue to enjoy the benefit of 0% taxation, which I think it's not a correct treatment, because there is no fair treatment between designated zone company and a free zone company. So it's like an unfair advantage to designated zone company. I hope when the cabinet decision comes on defining the non-qualifying income, this will be addressed. Any other mainland source income for a free zone person, it will be full taxability was there, and now they have introduced the concept of non-qualifying income. So any free zone company which sells goods to a mainland company, or they provide services to a mainland company, then on such, that will be termed as a non-qualifying income, and on such income, corporate tax at 9% will be payable. Also, in the public consultation draft, they had mentioned about the mandatory requirement for free zone companies to get their books audited to take advantage of the 0% taxation. However, when the corporate tax law was declared in December 22, there is no such mention about it, and it will be clarified via cabinet decision again. So what are the advantages as compared to mainland and free zone companies with the introduction of corporate tax? So main advantage, free zone entities enjoy the benefit of no corporate tax. Only there is you know compliance related requirement, as in they need, all the free zone companies will have to register and file the corporate tax. Same with the mainland companies. But mainland companies, one big disadvantage would be that even the mainland companies, they are exporting goods and they are generating profits on such transactions. Even such transactions, on such transactions, or the profits are made on such transactions, they will have to pay corporate tax at 9%. Now we come to the calculation of taxable income, how it will be calculated. So UAE government wants the UAE corporate tax to be a low compliance, and that is why they have not mentioned any mandatory audits as of now. But accounting books will have to be prepared. It is mandatory, and corporate tax will be charged on the net accounting profit or loss. On loss, no, losses can be transferred. Net accounting profit of the company, and the accounting profit will be based on the generally accepted accounting principles in UAE. There can be a relief for small businesses which are preparing their accounts on cash basis. They can continue to do so, but they will have to apply to FTA for such a benefit. UAE has also given the flexibility in terms of each company can have continue with their own financial year. We have seen in other tax jurisdictions or other countries which have implemented corporate tax, that they define the period of tax. UAE has kept flexibility on that basis as well. And each company having their own financial year, they can continue to have their financial year and pay the tax accordingly on that financial year. If any company has not defined their financial year, then as per law, by default, it will be considered as a calendar year, which is Jan to December. And carry forward of losses will be allowed. So that we'll discuss later in other slides. Now, when getting to your accounting net profits, there are some restrictions and there are some adjustments that will have to be given to your accounting net profit to derive at a taxable income as per the corporate tax law. So one such adjustment will be for the unrealized gains and losses. Now, this particular slide was taken from the public consultation draft, wherein they had mentioned that any gains, unrealized gains or losses, which are capital in nature. For example, the property valuation, most common we can see here in UAE, lot of companies in their balance sheets have investment properties and they revalue each year based on the valuation report. So any revaluation profits or losses as per the valuation report that is taken as an accounting net profit, it will not be considered as a taxable income. It will have to be added back or reduced accordingly based on it is profit or loss, and corporate tax will be paid only on the balance after the adjustment profits. However, if there are unrealized gains or losses on revenue items such as revaluation of inventory or provisions or currency adjustments, that can be part of your normal accounting net profit, and no adjustments are required on that side. Again, this was as per the public consultation draft, and UAE corporate tax law is silent on this. Hopefully a cabinet decision will clarify. There are certain source of income which are exempt. Earlier, when I had mentioned about the government entities, investment funds, those were the exempt type of businesses. Now, this is exempt income. Both are different concepts. This is exempt income, wherein they have defined that if any company or any individual person, as well in this case, is earning dividend or capital gains out of their investment in another company, then such income will be exempt from UAE corporate tax. For this, there is a mandatory condition that at least 5% shareholding should be there in the company. And for if you have an investment in a foreign company, so then in such cases, that such foreign company in which you are holding the investment and you are earning the dividends or capital gains, such foreign company should be subject to tax at the rate of at least 9%. Another exempt income is any income earned by your foreign entity. Let's say a UAE mainland company sets up a branch in India, again, or you can say anywhere in Europe or USA, and they are earning profits in that particular company, then such profits will be exempt in UAE only if they are paying corporate tax or the tax on their profits at the rate of at least 9%. Another specific exemption is given to aircrafts or the companies that are engaged in the business of aircrafts and ship operation of aircrafts and ships, but the conditions related to it is it will such exemption is only given to the non-resident companies like foreign companies like foreign airlines carrier, and on this exemption will be given only if same treatment is given to UAE similar kind of UAE businesses in that particular country. There will be very less amount of companies in this category. There are certain expenses deduction. There are limitations to it. One being the interest expense. Interest expense, if a business has leveraged themselves and is taken a business loan, then the interest expense will be deductible only up to 30%. It is capped at 30%, and any additional amount about 30% of EBITDA will be added back to the profits for the calculation of corporate tax. Also, they will, for ease of calculation, they will announce a minimum threshold. Let's say for a year, 100,000 interest expense, then the 30% cap will not be applicable. So that is still awaited. And this particular clause of interest expense, capping of interest expense at 30% is not applicable to banks or insurance companies or natural persons and other regulated financial services entities. Also, there is one more cap on the entertainment expenses. So businesses, if they do any expenses that are in the nature of entertainment, like business lunches or you or recreational activities for your staff, then such expenses will be limited to only 50%, and the balance 50% will be added to your accounting profit to get to the taxable income. Also, any fines and penalties that are incurred by the company, that will be added back. Even if you have put it as an expense in your accounting profits, it will be added back to the accounting profits to get to the taxable income. Input VAT, which is claimed by the companies, again, it's obvious that it won't be allowed as a deductible expense. And donations paid to unapproved charity organizations will also be disallowed. So make sure that any companies that are doing donations during Ramadan, we see a lot of donation activities done by the companies in UAE. And if you are paying such donations to an unapproved organizations, then it will be disallowed as per corporate tax. You will not be such expenses will be added back to your accounting profits and to derive at the taxable income. There is again a concept of group which is very different to the concept of group as per VAT registration, which worries me a bit. And also there is provision of transfer of losses between group companies and in case any company is doing intra-group transfer of assets and liabilities, or they are doing any restructuring within the group, then such transactions will be exempt from corporate tax. We'll see in the later slides. So yes, tax groups can be formed in the corporate tax as well, but the conditions are very different as to how we were forming a tax group in as per the VAT registrations. So here, two companies can form a tax group for corporate tax purposes only if one company or the parent company is holding at least 95% of the shares of the subsidiary company. There was no such condition under the VAT group registration. So in corporate tax, it is the parent company has to hold at least 95% of the shares or the voting rights of the subsidiaries, and then only it can register as a group. Also, there is a condition that the subsidiary should not be an exempt person or a free zone entity, and all the companies who want to form a group, all the companies must follow the same financial year. It cannot happen that the parent company is following the financial year of from, let's say, July to June, and the subsidiary is following the financial year of January to December. In such cases, they'll have to first align their financial year to make it same, and then they can register as a group. Once you're registered as a group, the group will be, let's say it's a group of 10 companies. The whole group will be treated as a single person, same treatment as in VAT, and the parent company will be responsible for the administration and payment of the corporation tax. The parent company will have to consolidate the financials of their books along with all the subsidiaries. That is requirement as per IFRS as well. If you are holding shares in a company more than 95% or more than 50%, you need to consolidate your books. And when you do the consolidation, it's obvious that you will eliminate the intra-group transactions. So that will have to be excluded. And all the companies that are part of a corporate tax group will be jointly and severally liable. Transfer of losses, let's say many companies do not qualify for the criteria of 95% shareholding, but they are still a group company and they have at least 75% shareholding. Let's say parent company is holding at least 75% shareholding of its subsidiary. They will not be able to form the group, but there is a benefit of transfer of losses. In such cases, the loss of one particular company can be set off against the profits of the profitable company to the extent of 75% of the taxable income. Rest can be carry forward. Carry forward of losses is allowed indefinitely, but the adjustment will be only limited to the 75% of the taxable profits. And no losses can be transferred from the exempted companies or those benefiting from 0% free zone companies. That is obvious. Restructuring relief, as I mentioned, if any companies or two companies are into restructuring their business and they want to do a merger or an acquisition, or there is intra-group transfer of assets or liabilities, then such transactions will be outside the purview of corporate tax, certain subject to certain conditions, that such assets and liabilities that are transferred are on net book value. There is no profit margin or no markups added to such transfers. And this exemption is conditional as to no further transfer or restructuring is done within next 3 business years. If you fail that, then whatever transaction you had done of mergers or acquisition or transfer of assets or liabilities, it will be treated as taxable as per the corporate tax, and any profit generated out of that can be taxable. Next concept is of transfer pricing. This is the most important, and UAE has added their own twist to it. So what is transfer pricing? Transfer pricing will be applicable to any transaction or arrangements between two related parties, two or more related parties, or two or more connected person, or any transactions or arrangements done with the connected person. So for now, for this, obviously, we need to know what is a related party and what is a connected person, right? So what is a related party? A related party can be any of these. Any person holding shares or has a common ownership or is a relative to the fourth degree of kinship. So it's like your great 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 grandfather until great 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 granddaughter or grandson. So if a person has that relationship, then it will be considered as a related party. If any individual alone or with a related party owns 50% or more shares in a company, then again that they will be considered as having a related party. A legal entity alone or along with another legal entity holds 50% or more shares in third company, then all those three companies will be considered as a related party. A branch or a permanent establishment of a company is obviously a related party. Partners in same unincorporated partnerships, those partners will be considered as related to each other. Exempt and non-exempt businesses of same person will also be considered as a related party. There is one more definition, which is connected person. So this concept is like wherein a person, so the connected person is defined that any director or officer of a taxable person will be considered as a connected person. Any individual who has ownership interest or controls the taxable person will be considered as a connected person. The partners of the taxable person will be considered as a connected person to that taxable person. The relative of the owner, director, or officer of a taxable person up to the fourth degree of kinship will also be considered as connected person, and any other related party will also be considered as a connected person. Now, why this is very important? Because any transaction a taxable person or a registered person or a registered resident person does with any of the related party or with any one of the connected person, it will come under the transfer pricing rules, and they will have to justify the value of that transaction or the consideration received against the transaction, because it's very easy to transfer the liability of taxation when you are dealing with a related party or a connected person. So for businesses to not be able to take advantage of such ad- arrangements, they have put the clause of transfer pricing. So for connected persons, specifically in the UAE corporate tax, it is mentioned that any payments or benefits provided by a business to its connected person will be deductible only if business can demonstrate that the payment or benefit corresponds with the market value of the goods or service provided and is incurred wholly and exclusively for the purpose of the taxpayer's business. Now, why this particular, I can give you a very simple example. When the corporate tax was introduced, salary is the most easy deductible expense, right? You paying salaries to your employees. Now, in our business, we have a lot of relatives as well, or they become a connected person, and it's very easy to increase their salary in the books and reduce the liability of tax. But if you have a thought in that mind, please do not, because there are provisions wherein they can come and check that whether the salary that you are paying to any of your connected person, or I can say relatives, will come under the purview of transfer pricing, and you will have to justify such transaction. And if you are not able to justify, then whatever the authorities will feel that you have exaggerated, that amount will be added back to your profits and you will be charged for the corporate tax, and also the penalties will follow. That goes without saying. Yeah. Also, any transactions between two related parties or connected person has to be done on an arm's length principle. What is an arm's length principle? It is simple that transactions should be valued as if they had been carried out between two unrelated parties, each acting in his own best interest. So each companies will have to follow the arm's length principle, and the UAE corporate tax points out at following the OECD guidelines on the transfer pricing. And they have also mentioned there are, for any transaction between two related parties, there are five methods which you can use to value that transaction. Or you may do the transaction, but when the authorities come and ask you, you will have to justify the value of that transaction based on the five methods. The first one being the comparable price method, second one is the resale price method, third one is the cost plus method, fourth one is the transactional net margin method, and fifth one is the transactional profit split method. Now each of this method can be used to justify your transaction with the related party, and extensive document must be maintained. Now this is where one of it's, I would consider it as an advantage for group companies to register as a tax group, because if you are registered as a tax group, as such you will eliminate any intra-group transactions. So in that case, most probably you will not have to do the extensive documentation and working for the transfer pricing regulation. If you are not registered as a tax group, even after being you know eligible to register as a tax group, then any transaction, intra-group transactions you do, that will be considered as a related party transaction, and you will have to maintain the extensive documentation. Transfer pricing requirements, as I mentioned, we have to follow the OECD guidelines, select the most appropriate valuation method, and as per the OECD guidelines, you will have to maintain two files. One is the master file and the local file as per the OECD format, and the extensive documentation related to the transaction will have to be maintained, should be maintained. Now, this particular subject is very subjective, and it's it can vary from transaction to transaction. So we have the experts in the company to help you with this. And if you have any intergroup transactions, I believe you should start identifying it out, and also try to make sure that you are making the transactions with your group companies or related parties at a fair value. at an arm's length principle. Administration, as I mentioned before, it will be applicable for financial year starting from 1st June 2023. Registration is mandatory, and the return filing should be done within 9 months from the end of your financial year. So, if we'll see the timeline in the later slide, and also the payment of tax should be done within the 9 months from the end of the financial year. So this is the timeline. So let's say if a company is following the financial year from June to May. So for them, they will be the first ones to pay the or file the corporate tax return and also pay the corporate tax. And their first period for filing the corporate tax will be from 1st June 2023 to 31st May 2024, and they will have to file the return for corporate tax and also pay the due corporate tax before from 1st June 2024 until the 9 months, which will be like 31st March 2025. Similar for Jan to December, most of the companies we see they follow financial year from January to December. So for them, the corporate tax will be applicable to the financial year starting from 1st Jan 2024. It will They will be enjoying free period from 1st June 2023 until 31st December 2023. Don't worry, you guys don't need to pay tax on that proportionate amount for that period. And similarly, the most happiest would be the businesses that are following the financial year from April to May. So for them, the first financial year starts from 1st April 2024 until 31st March 2025, and accordingly they will have to file the corporate tax return and make the payment within the 9 months. So that will be like 31st December 2025. Now, so much information, so many laws. I believe VAT was very simple as compared to corporate tax, because in VAT we know that it's first of all not cost of doing business, and secondly, you whatever you sell, you just add 5% to it, and whatever you have purchased, you are paying to the supplier 5%. Net difference you pay to FTA, you are sorted. There are some confusions with respect to zero return stuff. That's it. Also, implementation was quite simple. But with corporate tax, it's not gonna be that simple. We have been doing a lot of meetings with our clients, and we have also started advising them on how they need to restructure their business and how they need to see the impact of corporate tax. And accordingly, we have developed an approach wherein we plan to implement or help our companies to implement the corporate tax. One being, initially, we need to do, or even if you are not hiring a consultant, you need to do this exercise within your company, wherein you need to see exactly how the corporate tax is gonna affect your company. You need to drill down to transaction level recording of your accounting books. If you are not maintaining the books of accounts, then God help you, please do start maintaining. It's absolutely mandatory. And if you are maintaining the books of accounts, then you need to drill down to transaction level to see whether you are recording each and every transaction correctly or not. You need to see with respect to your capitalization policies, whether you are following similar capitalization policies. For example, let's say a company has multiple branches and each branch has a separate accountant. At one branch level, they capitalize the laptops purchased for the branch, and they depreciate it over 3 years. Another branch, they don't have a capitalization policy, and the accountant thinks it's a small expense, I will write it off. So there is no set accounting policies within the group. This kind of situations also we have seen. Also, you need to see that have you hired any related person who is working. Also, the directors and officers of the company automatically become the related persons, and you need to see that are you any transactions or even the salaries of such employees is at an arm's length principle, and are you able to justify, is it at the fair market value, Also, very important point we have seen while implementing the corporate tax, that a lot of companies, mostly it happens in where there are multiple companies in a group, wherein uh, employee has a visa from a particular group company, but is working and allocated to another group company. How we are going to treat such transactions absolutely needs to be looked into, and needs to be sorted out before the implementation and before the start of your financial year for the corporate tax. So we as a business, as a consultant, we do a complete checkup of your profit and loss, and we see to each and every line item of your GL how it is affecting, whether your entertainment expenses are recorded correctly, whether you are recording your personal expenses done for the shareholders or owners, whether you are recording it in correct account head, how it's going to impact, what is your profitability as of now, how your corporate tax will be calculated, what will be your corporate tax. And also you need to do a deep dive thinking on, because this corporate tax will be like from the profits of the company, so you need to see whether you need to increase the margins for your products or services, because once the corporate tax is implemented and it's applicable to your company, whatever profits you are generating, 9% will be taken away. So you'll be earning less. So you need to see whether you want to take the hit or you want to pass it on to your clients. That is also a very important decision to make. Also, any group companies are there, then whatever transactions you are doing between two group companies or connected person, you need to see the extent of transfer pricing documents that you need to maintain, and you have to start practicing it from now on, so that by the time the corporate tax is applicable to your financial year, you are ready with it. Also, training needs to be given to the staff as to specifically the accounts division of how to record the transactions, and they should be aware of, if a wrong recording is done, there can be repercussions to it. It's subject to penalties from the FTA. So special emphasis has to be given, and your staff needs to be trained with respect to the corporate tax provisions. And very latest thing, the FTA has started the registrations for corporate tax. And my take on it is, as of now, the process is quite simple. And we had experienced the same thing when the VAT was introduced. As in, when the law starts maturing, then FTA increases their requirements. So I would suggest you start registering your companies for corporate tax. So all this seems impossible, but I have a quote for you. Start by doing what is necessary, then do what is possible, and suddenly you are doing the impossible. That's all from my side. We can start with the Q&A.
Yes, Samir. Good evening. Thank you for your presentation. Could I go in?
Yeah, sure.
Yeah, I'm just asking about, I don't know if you covered it or not, about holding company, which sometime holding a company and the daughter company is they are making profit, then giving dividend to the holding company.
Right.
Does the holding company, how to handle the holding company that? Does it going to be tax or how it be done?
See, as I mentioned, there is the dividend income is an exempt income. So in case a company or an individual is earning dividend income,
Yeah.
you please mute.
I'm calling you from Wealth Capital. Okay. It's regarding online trading, stock market investments. Not in.
Yeah, so sorry. So if an holding company is getting dividend income from its subsidiaries, and the subsidiary is subject to corporate tax, then such dividend income will be exempt, because practically it will, if they are taxed again, it will be taxed twice, which will not make sense. So they have put it as an exemption, but the requirement is that there should be at least 5% shareholding. If your shareholding is less than 5%, then it's not exempt and it will be taxed again in such cases.
Thank you.
So, actually, I would like to introduce one of our colleagues, which is Mr. Abdul Qayyum. He is an ACCA affiliate and has passed CFA level 2. He is currently working as a tax advisor with Nadeem and Umendra Chartered Accountants. Previously, he worked with PKF International in Pakistan and has a deep insight to UAE's taxation and compliance regime. So, he would be joining us for the Q&A session as well. We have a certain questions in our chat box. I would go from the first one. There was a question which asked what was qualified income, which we already went through. Then, yeah, the next one would be that does the entity is the entity required to have a detailed fixed assets register that clearly distinguish between deductible fixed assets and capital items that maximum depreciation allowance can be claimed under corporate tax, like India?
So as per the federal decree law, so there's no mentioning of depreciation in the law, but but in the law it's mentioned that the companies they have to maintain their records for 7 years. So you'll have to maintain records of your fixed assets, but about depreciation, how much you can claim, that will be clarified in the minister cabinet decision.
Thank you. The next one was from Mr. Shiv Kumar Hirani asking that do they need to register a company who does not have any annual profit of AED 375,000?
So yes, you have to register your company even if your annual profit is below 375,000. But in the law, they have mentioned there will be some relief for small businesses who have a turnover less than a certain threshold. And that threshold, again, they'll mention the details of that in the cabinet decision.
All right. The next one is that how to ensure that the entity has an overall tax efficient financing structure considering the limitations related to deductibility of financial expenses.
Could you come again with the question?
How to ensure that the entity has an overall tax efficient financing structure considering the limitations related to deductibility of financial expenses.
So see, that's what I was saying, that it's very important for businesses to not take this lightly and start looking at the provisions, and also start looking at their profit and loss and see that how they can maximize the tax saving and do within the purview of law. So how they can ensure the overall tax efficiency, it will depend on what is their leverage as of now, and there are so many criteria that needs to look into. So we can, in this specific, we can comment once we go through their books, then we sure will be able to help them in this. Khushbu? Khushbu, you are on mute.
Oh, sorry. If a mainland company is more than 50% shareholder in a free zone company and the free zone holding company is less than 50% shareholder foreign ownership, is the free zone company still 0% taxable if only export services and products are provided?
See, in this case, if a mainland company is more than 50% shareholder in free zone company, so free zone company has its own existence. And in that case, the free zone company is doing business outside UAE or within the free zone, then it will continue enjoying the 0% taxability. That should not be an issue.
All right. I have requested Ms. Talat to put forth her question. She isn't available. Okay. The next question is from Mr. Samar Mahtani. Is any of this corporate tax applicable for holding investment company not selling any goods within the UAE and has just purchased a property and maybe done some trading?
Yeah, it
The-
will be applicable. Yeah, Abdul, go ahead.
So if yes, the corporate tax will be applicable, and the trading, it depends what kind of trading you are involved in. And the property, yes, if the property is in mainland, the corporate tax you'll have to pay 9% tax on that income. If it's in free zone, then that rental income will be taxed at 0%.
All right. So the next question is from Ms. Jen Simon. If our mother company is based in UK and are paying the corporate tax of 19%, are they exempted in paying the corporate tax in the UAE?
So basically, if a parent company is in UK, then that means you have a separate subsidiary in UAE. So if a subsidiary is a separate company, then the corporate tax is applicable and you'll have to pay taxes in UAE.
All right. The next one is, is the entity required to have a detailed fixed asset register that clearly distinguishes between the fixed assets and capital items that maximum depreciation allowance can be
I think
claimed under the corporate? This is the same one. Sorry. Mm, please explain about the designated zone. If designated zone sales to mainland company, is it taxable or not?
See, as I mentioned in the free zone applicability, we had discussed different type of transactions. In that, that was as per the public consultation draft, wherein they had mentioned that a designated zone company selling to a mainland company, it will be considered as okay transaction and no corporate tax at 9% will be applicable. However, now with the introduction of the corporate tax law, which they have declared, they have qualified into qualifying income, sorry, classified it into qualified income and non-qualified income. And non-qualified income is yet to be defined via cabinet decision. So once the cabinet decision is out, for sure we'll have the complete clarity with respect to free zones, designated zones, and financial free zones.
The next one is from Mr. Sriji. He has asked that how to treat owner expenses like his remuneration.
So so if owner is withdrawing salary of his company, then arm's length principle is applicable on this, and you basically you'll have to check what the market salary for the owner is going to be. So
Again, the question for what rules will apply to offshore companies registered in free zone?
It will be applicable, as I had mentioned. Registration and return filing is mandatory for all companies registered in UAE.
Uh, for free zone, who does not? Oh, perfect. If a mother company is based in UK paying, okay, this one is done in cash of tax group, the tax percentage will be applied based on group income slash consolidated income or separate subsidiaries have to pay the tax according to their net profit threshold.
so if the group is registered as tax group, then you have to file one tax return. But if the subsidiaries are registered separately, then you have to file separate return for each subsidiary.
Ms. Talat wanted to speak with respect to corporate taxation in professional services. Is she available?
So I think he's asking whether he has to pay corporate tax if the income is from professional services. So yes, you have to pay tax if you are deriving income
So
by
it's
professional services.
applicable to all types of activities, all type of incomes. Specifically exempt incomes are defined, which we have discussed, which is dividend income and foreign branch profits if they are being taxed, and the income earned by the non-residents. I'm repeating that income earned by the non-resident companies who are into the business of operation of aircraft or ships. This is the income which is specifically exempt. Apart from that, any income that you are earning is going to be under the purview of corporate tax law. And also all type of activities and businesses are liable to corporate tax. But again, there are certain exemptions which we discuss, like government entities, government controlled entities, registered charity, registered donations, organization, public pension funds, investment funds, those and the companies engaged in the business of extraction, and also companies that are into non-extraction but supporting the extraction companies in extraction of natural resources.
The next is any ceiling limit fixed or for shareholders or managers in the license expense?
Mm, any ceiling limit fixed for shareholders, manager, and license expense? I don't understand.
Okay. Uh,
With respect to any ceiling limit for shareholders, see, shareholders managers automatically becomes a connected person, and I was personally expecting that a certain percentage of management remuneration will be defined. As of now, they have not defined it. They have just gone with easy compliance, which is they are want you to do it as at an arm's length, using the arm's length principle, but you for sure you will have to justify, and do not increase it to a level where you are unable to justify it. Let's say, for example, your company is making net profit of 1 million, and you are withdrawing management remuneration of 5 million. It's nowhere it's justifiable. So I hope that answers.
there's one question where they have requested to put some light on the penalties section as well.
See, penalties as of now for the late registration and late filing or tax evasion has not been defined, but it's going to be on similar lines or even more stringent as compared to VAT.
And there was a request to throw light on the anti-abuse provision as well. We did discuss this.
See, anti-abuse basically is speaking about that if with the introduction of the corporate tax law from 1st October 2023, that was the official date when it was presented to the cabinet. So after that, if you are taking any decisions or if you are making any changes in your company or the way you are recording a transaction in a company, which will give you an unfair advantage, which will result in low payment of corporate tax, then it will be considered as the abuse of law, and the FTA will have the right to reverse such adjustment and consider that it was not done, and accordingly calculate the corporate tax. So that's basically the idea of the anti-abuse laws.
There was one question regarding any tax incentives for the company in certain industries of UAE.
Well, as of now, there's no such incentive for any industry.
There's this if the owner is investing any share market or other investment, he is receiving earning, is it taxable?
Well, if the owner is investing in the share market,
Share market or other
so
investment.
So basically, the income from investing in other companies, if he has invested in more than 5% shares of that company, and the company is in UAE, then that income will be exempt. And if he's investing in companies that are outside UAE, then then again the shareholding has to be more than 5%. And then on top of that, whichever country the company is located in, the company must be paying at least 9% tax on those profits. If it meets those two conditions, then that income will also be exempt.
All right. This question is for the free zone DMCC. As a DMCC company with all its sales and purchases realized outside UAE, the tax number shall be taken and returned to be submitted with zero tax automatically, or should we get any approval to submit the zero rated tax?
So
So,
if you are a
Abdul, go ahead.
so if you are a free zone company, you have to register for the corporate tax and you have to annually submit your corporate tax returns. While filing your tax return, they'll ask you whether you want to elect for as a qualifying free zone person or not. And then you'll elect, and there will be certain conditions which will be specified in the cabinet decision. You have to meet those, and then you will pay zero tax on those and that income.
Okay. There is a request to explain the small business relief.
Small business relief, as of now, they have just mentioned that they will be defining small businesses as per a cabinet decision. And as per the definition, any businesses that fit that definition, then such businesses will be exempt from corporate tax. They will not be needed to register for corporate tax. So ideally, what I feel, maybe it will be based on certain turnover, wherein a company does not have a certain amount of turnover, then they might be exempted from registering for corporate tax, or they will have to apply for register for sure and then apply for the exemption.
There was a question from my end actually that does the corporate tax belong to a direct tax or an indirect tax category?
Okay, that I had explained before as well. See, corporate tax is a direct tax. Why? Because the tax will be collected from the net profits of the company, as compared to VAT, which was value added tax, which was indirect. Why? Because when the companies were selling goods to another company, they were charging 5% VAT on top of it and paying to the government. So it was not a cost of doing business. VAT was not a cost of doing business for the companies. It was indirect tax. The end, you know, the end, I would say, I'm not getting the term. The end baggage of the tax, I would say, I'm not getting the right term. The end baggage of the tax was on the consumer. So consumer was paying the 5% ultimately to the government. But with corporate tax, it is a direct tax which is directly on the net profits of the company at 5%.
The next is that the gain on sale of fixed asset will also be taxed like revenue.
Yes, so if you have gain on sale of fixed assets, yes, you'll have to pay 9% tax on that as well.
There's an out of box question that is an audit firm doing accounting work for my company can do their audit as well.
Sorry.
If an audit firm is doing an accounting for a certain company, can they do this that same company do their audit as well?
Your link is the link. Any claim okay.
See, there are many ways of how it's being done, because we see for Big Ten as well. They have all kinds of services being provided, and for each service they have a separate designated partners and a separate uh, team to carry out such functions. So it completely depends on how the structure of that particular company that is providing the service.
There's a question that is small business relief applied to resident and non-residents.
Small business relief, yeah, it ideally it should be, but we'll have to wait for the cabinet decision to define it.
The corporate tax applicable from the beginning of the company's first financial year starting after June. Yeah, it is correct. There is one more thing, that do they have to submit the audit report while submitting annual returns?
Well, as of now, there's no such condition, but they have mentioned in the law that they will specify in cabinet decision which type of companies have to submit audited accounts. In the public consultation draft, they have mentioned that the free zone companies, they'll have to get their accounts audited. But now we'll have to wait for the cabinet decision to see exactly what type of entities will be required.
There's one more message, that for how many years the free zone will have tax holidays?
So it depends on the free zone. Mostly when you register a company with the free zone, they say 50 years no corporate tax. So as of now, it seems to be that. Then later on, once that 50-year period gets over, then we need to see how it's being taken care. But there are provisions in the corporate tax law for the free zone authorities to renew that promise, I would say. I believe we have answered most of the questions now. And still, in case any of you have questions, you can still write to us. So I'll just display my contact details. These are my contact details. Please feel free to share your questions. And I can see from most of the participants, they are our clients, and don't worry. So we are there to handhold you in each and every step of implementing this corporate tax, and hopefully we should sail it smoothly. And yes, we will share the video recording as well as PPT by most probably tomorrow to all the registrants for this webinar. Thank you so much, everyone, for giving us this opportunity and taking out time. Khushbu.
Thank you. Thanks, Abdul.
Okay.
All right. Thanks a lot. Bye-bye.